Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Welcome to The Critique. Today, we're analyzing a Goldman Sachs research report from January 2026, reinitiating coverage on Microsoft.
Right, with a $655 price target, about 37% upside from when it was published.
And this is a really differentiated piece of analysis.
It is. Its core value is that it really challenges the market consensus. The idea that Microsoft's AI positioning is, more bearish than the reality?
It argues the firm's strategic investments are actually poised to deliver some pretty outsized returns.
The thesis gives this remarkably clear path to generating over $35 of EPS by fiscal year 2030.
And to put that in perspective for a moment, that implies growth over a 20% compounded annual rate.
Which is, that substantially outpaces the mid-teens median growth of their trillion-dollar market cap peers. It's a big call.
And the entire differentiated view rests on Microsoft's unique vertically integrated strategy.
That's right. The whole infrastructure, platform, and application stack. The report calls it the IPA construct.
And the argument is that this verticality, the structure, is what really limits the downside risk better than almost any other tech giant out there.
Which leads us right into the core question the analyst is trying to answer.
And it's not the simple question of if AI will drive growth. Everyone agrees on that.
No, it's more precise. It's when. When does this massive investment cycle finally transition into a harvesting phase?
Exactly. When does all this concentrated CapEx spend start converting into outsized revenue and, more importantly, earnings growth?
And we have to just pause on the scale of that investment. CapEx for fiscal 26 is expected to hit a $148 billion.
Which is just a staggering number, a 400% increase over fiscal 22.
Right, the pre-Chat GPT levels. This is not a gradual ramp-up.
And the immediate constraint here isn't demand, it's physical capacity.
And Microsoft themselves expect that to last through the end of fiscal 26.
Which is such a vital piece of context because it explains why the traditional metrics,
the simple ones, yeah,
linking CapEx directly to Azure revenue growth, they're just less useful right now.
Well, it's about a strategic trade-off, isn't it? Microsoft's been open about having to strategically allocate their compute resources because of these supply constraints.
So they're trading what investors usually love, near-term predictability, for what they believe is a much stronger long-term competitive position.
A bigger moat in the AI landscape.
Okay. So that brings us to the key assumptions that are really driving this bullish thesis. Let's dig into the first big claim, which is about that CapEx allocation.
The analyst assumes this strategic allocation yields a structurally higher ROI than just, maximizing immediate Azure revenue.
And this is where the report gets really granular.
It does. It uses a framework that breaks that massive CapEx spend into 4 buckets. You've got Azure IaaS, internal R&D, that's MAI, first-party apps like Copilot, and then maintenance.
Right. So for listeners who aren't in the weeds on this every day, why is that choice, prioritizing those non-IaaS buckets, why is that structurally better than just taking every Azure dollar that comes in the door?
Because the unit economics are completely different. The assumption is that dedicating compute, estimated at 9% for R&D and 16% for first-party apps in FY26, it just results in structurally better long-term outcomes.
Better outcomes because you're capturing high SaaS margins on top of that infrastructure layer.
Precisely. You're building an application and an agent moat that will pay off for much longer than just selling raw compute cycles today.
Sacrificing some current Azure growth for future high-margin leverage in applications.
Exactly. Which leads right into the second major assumption, and this one is fundamental to the entire long-term margin story.
That Azure AI gross margins will re-rate back to classic cloud levels over time.
And wow, that is an aggressive target. The model has Azure AI gross margins going from the low 30s today.
Which is really, 18 to 20% if you exclude the OpenAI revenue share?
That's right. All the way up to the pre-AI highs in the high 60s.
If they pull that off, it fundamentally changes the entire profile of the business.
It's a massive bet, but the report cites 3 pretty compelling margin levers to get there.
Okay, what are they?
First is vertical integration of custom silicon. Microsoft's targeting over 50% of its AI infrastructure to be internal.
And that alone is modeled to do what?
Improve Azure AI gross margin by up to 20 points.
Okay, that's huge. What's number 2?
Continuous efficiency gains, like the 30% they reported on GB300s back in November of 25.
And the third lever?
This one's more of a wild card, the potential for radical, nonlinear algorithmic breakthroughs.
Like recurrent neural networks replacing the transformer model, something that just drastically improves token efficiency.
Exactly. And that brings us to the third core assumption, which gets to the monetization layer.
Which is that KaiPilot 365 penetration is going to compound PBP growth significantly.
PBP being productivity and business processes.
So, is the key takeaway here that the PBP segment is really the high-margin heart of this whole thesis?
It absolutely is. The entire thing hinges on successfully upgrading that massive O365 installed base.
Which is what, about 450 million seats right now?
Around that, yeah. That is the leverage point.
And the numbers seem to bear out that potential impact?
They do. The scenario analysis suggests that every 10 points of penetration drives 10% growth in the PBP segment.
So that $30 add-on license for Copilot, that implies a potential opportunity of what, $120 to $160 billion?
Just within the existing install base, all supported by that entrenched enterprise moat Microsoft has built over decades.
Okay, so the analysis is extremely robust, but we're here to critique and strengthen it.
Right. Let's shift our focus to the areas of fragility, which the analyst does correctly identify, and see how we can provide maybe a tighter, more actionable framework.
I think the most important opportunity is clarifying the biggest unknown. The report needs to provide a more explicit sensitivity framework around the massive, but very opaque OpenAI contract.
The weakness is clear. That $250 billion commitment for Azure services, the revenue share agreement, they're fundamental to the forecast, but we have almost no public details.
Right. No clarity on duration, baseline revenue, the exact rev share percentage.
And while the analyst applies these big blanket discounts, 40% to the contract, 50% to the rev share, it makes the model feel a bit dependent on an arbitrary discount factor.
So to strengthen this, the suggestion is to reframe it. Move away from simple percentage discounting to something more like time-based certainty modeling, or maybe scenario probabilities around the contract duration and ramp.
Investors need temporal guideposts, not just arbitrary price cuts.
Exactly. So what's a concrete example of how to do that?
Well, the analyst could model the $250 billion commitment with both a high probability 5-year ramp and a lower probability 10-year ramp. Then you can explicitly show the difference in, say, FY27 and 28 revenue.
And crucially, you highlight that the bear case, which discounts OpenAI entirely, still gets you to a really robust $27 FY30 EPS.
Which confirms the strength of the core business, independent of that contract's full realization.
Okay, let's look at the custom silicon assumption next. For the thesis on gross margin re-rating to be fully persuasive, the report needs to bridge the gap between those aspirational targets and the known execution lag.
Yeah, this is a real point of friction. The weakness is that the thesis assumes this rapid, successful execution.
Hitting 50% plus of AI infrastructure with their own chips.
To get that 20-point margin uplift, despite some evidence that their custom silicon efforts have lagged some peers recently. The whole margin expansion story depends on this succeeding on schedule.
Because if that ramp is slow, the company stays overly reliant on high-cost merchant silicon from, NVIDIA.
Which limits the projected gross margin recovery and delays that critical shift from investment to harvesting.
So the suggestion is to focus the analysis on defining some early-stage operational unit economics, milestones that go beyond just market share or volume.
We need quantitative anchors that prove the margin recovery is actually on track. We need to give the investor monitorable metrics.
So what should they be demanded?
I'd say 2 specific internal metrics. First, the time to deploy metric for their latest custom silicon versus merchant silicon in new data centers. And second, the internal cost per inference query, benchmarked against the best GPUs out there.
Providing that kind of quantitative validation, even if it's hypothetical or based on management commentary, helps solidify the path to that 20-point margin improvement.
It makes it real.
Okay, let's move to the third critical opportunity. This one relates to the Copilot layer. While the report champions Microsoft's orchestration layer, the risk that high-margin packaged software gets displaced by bespoke enterprise solutions, that needs a deeper look.
This is where we need a bit of intellectual skepticism, right? Is there a risk that focusing only on that $30 Copilot add-on misses the point? That value could accrue away from packaged software toward custom agentic applications.
Right. If customers are building their own highly bespoke agent architectures outside of the M365 environment, even if they're using Azure tools,
It validates that structural shift risk.
so the weakness here is that the report emphasizes the PBP revenue upside, but maybe understates the margin risk. The risk that customers use Azure IaaS and Foundry for custom agents instead of the high-margin packaged Copilot suite.
It's a mixed shift problem. The shift still benefits Azure, but it would compromise the quality and predictability of that high-margin PBP segment.
So we need an explicit metric to monitor this cross-segment margin risk. Maybe a PBP Azure margin delta.
A suggestion is to track the adoption patterns of the custom tools. That's what tells you where the value is really accruing.
Okay, give us a concrete example. What should investors be watching?
They need to watch customer adoption for Copilot Studio. That's the custom agent builder within the high-margin M365 environment versus the deployment of generic agent control plane services directly on Azure IaaS.
And if Studio adoption lags the IaaS agent deployments?
That's the signal. It signals value is migrating down the stack, and it warns investors of a potential adverse revenue mix shift in PBP. It's a critical long-term indicator.
That's great. So that gives us 3 high-impact, actionable areas to tighten up the analysis. Now, regardless of the outcome of those sensitivities, the report does an excellent job identifying key structural things investors must monitor.
Absolutely. Quarter-to-quarter volatility aside, these are the big ones. And one of the primary indicators of that investment cycle shifting is CapEx trend stabilization.
And the key here is to focus not on the absolute dollar amount of CapEx.
No, but rather on the magnitude of the upward revision stabilizing and then starting to decline.
That stabilization is the signal. It means the industry is nearing a supply-demand equilibrium.
Which is the necessary prerequisite before Microsoft can really allocate compute to maximize monetization instead of just building out capacity. Until then, the investment cycle is still in charge.
The report also highlights a crucial strategic point: the inference workload strategy.
Right. Microsoft's focus is heavily weighted toward high-margin inference workloads, currently about $10 billion in revenue for Azure AI, over the lower-margin training workloads.
And this distinction is very strategic. It was signaled by those data center lease cancellations back in 2025.
It emphasizes stability, lower latency, and fungibility close to customer locations. Investors should keep monitoring how this differentiation plays out against competitors who are just focused on maximizing flops.
A third crucial element to watch is the nonlinear R&D outcomes from Microsoft AI, or MAI.
This is where the truly exponential, non-consensus returns might come from.
It refers to that 5% of R&D compute spend that's dedicated to the MAI superintelligence team.
Right. And the notes highlight successes in places like medical superintelligence. The MAI DEXO model achieving an 85% pass rate on those AnyGem case challenges.
That's fascinating because successes like that in medical AI or clean energy AI, they represent massive new potential markets.
$100 billion TAM estimates that are just not priced into the stock today. They represent a huge potential IRR on today's CapEx.
And finally, we can't overlook the security moat reinforcement.
The security business is already immense, $20 billion in 2023, and the trend toward best in suite.
Those E3 to E5 upgrades, security copilot adoption,
It all significantly reinforces the overall enterprise moat. It's a high-margin defensive asset.
so investors should be tracking their market share gains in core security segments.
Definitely. For instance, endpoint share grew from 18 to 43% in 6 years. CSIM moved from 5% to 17% in 4. These are indirect, high-margin drivers that enhance stickiness across the whole platform.
And that makes the whole copilot thesis much more defensible in the long run.
Absolutely.
So, to summarize the analysis, the Goldman report provides a really robust framework for viewing Microsoft less as a capacity-constrained cloud provider
and more as a strategically diversified, vertically integrated platform, one that's aggressively positioning for the high-margin application and agent layers of the AI stack.
and our actionable suggestions centered on 3 areas of fragility.
First, Tighten the OpenAI analysis, using time-based certainty modeling, not just arbitrary discounts. Second, ground the margin re-rating thesis by demanding monitorable internal cost per inference benchmarks for their custom silicon.
And third, track that PBB Azure margin delta by comparing Copilot Studio adoption versus custom IaaS agent deployments to gauge the risk of value migrating down the stack.
And the most critical metrics for monitoring that overall transition will be the stabilization of CapEx revisions, execution milestones on their proprietary silicon and M&I, and of course, sustained high penetration rates for the M365 Copilot suite.
We look forward to seeing the refinement of this analytical framework. Please submit your revised research back to us or send in any other material for an in-depth critique.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.